Good afternoon, traders. It's Bill Baruch with Blue Line Futures, and this is your midday market minute as well as FX rundown. Tomorrow's non-farm payroll, and we've said it. Our narrative's been better data is going to help fuel the stock market higher. We need to see the market make a transition from Fed easing dependence to better data dependence. And look, we're at record highs after manufacturing PMI beat and ISM non-manufacturing beat as well. So we're seeing the S&P run into some resistance. 3256 was our next major three-star level, and then above there, 94.25 was a big level we blew through in the NASDAQ, and it's hanging out above. We also got 94.68. So there's other levels we have in the Morning Express. Check it out. But again, tomorrow we're looking at 160,000 jobs created expected. Above there, if we get above 200,000, you're going to see this market run into the weekend. Average hourly earnings expectations, not as important as they were last year and prior, but looking at a gain of 0.3. We want to see the consumer make more money. That's what's also fueling this market. A healthy consumer has been the big benchmark here for the market in general, fueling these gains that we've seen. So keep an eye on these numbers tomorrow. It's also going to affect the dollar. The dollar index is trading higher, but we do see some good resistance to the dollar index, 98.80. You have a trend line from the 2017 start coming in. It goes against last year's high, 98.80 in the dollar index. You got it about 109.5 in the euro. So those are two things to watch tomorrow. Some big support down there in the euro, some big resistance up there in the dollar. It'd be interesting to see how these trade overnight into the non-farm payroll report, because you could see as there's been a little bit of a breakdown, a new low here breaking in the euro. So if we see this thing fall and into that support, and then the number itself is not bearish the euro, and it's actually a bad number, bearish the dollar, you can see the euro lift up. So keep an eye on that. And then as well, gold's moving a little bit higher here today, as well as other safe havens such as the treasuries. Gold sold off sharply, but it fell into a major three-star, actually a rare major four-star support yesterday. And the treasuries, the 10-year yield hit 1.5%. We're seeing the yield overall started coming up, but stalled here today. So you're seeing the prices actually pick up here today instead. Overall, though, safe havens are going to be moving, whether the dollar is affecting gold, better data affecting gold, affecting the treasury. So keep an eye on that tomorrow. And then, looking at crude oil as well. Crude oil, we've turned a more upbeat narrative on crude oil. We've stayed neutral, but we've talked about ways we're playing long crude oil. Give us a call. We're here to help. We like being long. There's some creative ways to do it to reduce your risk. It's okay to be long as long as you're reducing your risk, managing that downside. There's a big trend line going back to 2016 on crude oil, coming in at $49. What matters right now is, will OPEC cut to fight off the lower Chinese demand right now? And the OPEC Plus committee cannot really come to terms on that. Saudi Arabia wanted to cut 800,000 barrels per day to 1 million barrels per day, and instead Russia doesn't want to. They tried to come to an agreement at 600,000 barrels per day. Doesn't seem like it's happening. If that happens, if you see 600,000 barrels per day agreed on, you're going to get a nice knee-jerk reaction higher in crude oil. There's a solid resistance, $53.25, $54. So do not chase into there. If you're long, that's where you want to take profit. But there's a lot going on out there. There's a lot of volatility. Give us a call. We're here to help set up trade ideas for you, help work with you. 312-278-0500. We're looking forward to hearing from you. And remember, futures trading involves substantial risk of loss. It is not suitable for all investors. Thanks a lot, and we look forward to hearing from you.